Welcome back to Good Revenue. In today's roundup, we will talk about trade policy whiplash, economic uncertainty, and the implications for businesses and for individuals. We also have a couple stories for you on AI. As always, all of the information and the research studies that we talk about can be found in the show notes. Let's jump right in. First of all, trade policy turbulence continues. I think the important thing to keep in mind with so much chaos and change in the economy, particularly in terms of trade and trade policy, is to try to understand the strategic intent and what might be happening behind the scenes. Because the day-to-day, minute-by-minute changes are exhausting and impossible for anyone really to keep track of. And certainly businesses trying to figure out how to manage investments, supply chains, strategic planning, other key considerations. I mean, you have no way of trying to navigate this as chaotically as things are unfolding. So what we're trying to focus on here are what are some of the big picture considerations to keep in mind, and what is some of the data that you should take a look at, in our view, to try to navigate all of this uncertainty. First of all, you may remember that on April 2nd, the president announced the most significant tax hike since 1930 in the form of a new tariff regime. Those tariffs were largely paused on April 9th. There was a 90-day pause affecting most countries with the exception of China. The tariffs that were previously implemented against Canada and Mexico, those unfortunately are also still in place. And across the board, there is a 10% tariff on most goods and services. So even though there is a relative baseline, it's really difficult to understand what's happening minute to minute as we get into this. So the economic reaction to all of this was immediate and severe. The market obviously cratered and then jumped back up on the April 9th announcement, only to drift down once again. Long-term treasuries are down. Capital investments seem to be frozen. IPOs have been canceled for the remainder of 2025, and M&A also appears to be paused, according to reports in both Reuters and PitchBook. China, on the other hand, has been very responsive and quite precise in their reactions. In addition to announcing retaliatory tariffs of their own, they've also quietly been implementing a series of non-tariff trade barriers that seem targeted towards red states. They're specifically targeting goods like beef, poultry, and liquefied natural gas, clearly to try to implement some kind of leverage. These barriers present significantly bigger challenges to U.S. exporters and manufacturers versus tariffs. And part of the reason is there's an opacity to how non-tariff trade barriers work and a subjectivity, unlike having a firm amount, which still has some complexity because, as we're going to get to in a minute, trying to actually administer and manage this complicated tariff regime is very likely going to be a nightmare for U.S. Customs. Since World War II, America has really been in the catbird seat, and we've been able to shape and influence global economic policy, often to our benefit. I think a lot of other democracies and people around the world have also benefited, but certainly it's been a really beneficial system overall for Americans. Certainly some sectors, some states, and some communities have been particularly hard hit by changes in trade policy, and there's been a significant underinvestment by the US government, particularly the federal level, in terms of helping communities that were affected by trade decisions or poor trade negotiations in the past. All of that is true. The challenge today is that we're having a debate now about whether or not we want a strong dollar or a weak dollar, if we want free and open trade or closed, isolationist economic policy. These are huge fundamental shifts to how we operate as Americans, both in our country and in the world. And there are equally large ramifications and implications for our trading partners, particularly our allies, and even for our adversaries with which we compete, like China. The implementation chaos seems unlikely to ease up anytime soon. Another example is that on Friday, the president announced exemptions for electronics to the great relief of the US tech sector, only to learn on Sunday that the Commerce Secretary, who seems to be best known these days for saying really out of touch things that seem to land him in memes all over the internet, the Commerce Secretary announced that actually chips would be part of a 232 program, which is an established process. We talked about this a little bit last week with our guest, and we'll link to that episode if you want to understand how that works. But that's a more established process that the Secretary of Commerce manages. But nonetheless, if you are a tech company or the customer of a tech company reliant on chips or other electronics, you have no way of knowing if you'll be affected and to what degree. Adding to the confusion is that there is still a lot of uncertainty about what the president's objectives are. As our guest last week put it, what does he want? The Washington Post reported over the weekend that they have gleaned some sense of the top priorities, and they are reduction on tariffs on U.S. exports, it seems relatively straightforward, preventing China from using other nations as third-party shipping proxies. This one is really complicated because it would involve countries like Mexico and Vietnam, which have Chinese subsidiaries or Chinese companies that are either shipping production or have set up manufacturing facilities in those countries specifically to avoid earlier rounds of U.S. tariffs. And so unwinding all of that is likely to be quite laborious for both those countries and us. And undoubtedly, they will be under oppositional pressure from the Chinese to not unwind all of that. So that's likely to be a point of contention. But at least in the case of that particular issue, if our policy as a country is to have clearer, fairer trade laws, which I'm supportive of, I think a lot of people are, then ensuring that a country, whether it is China or someone else, can't subvert our policy actually does make sense. Strategically, that makes a lot of sense, actually. The problem is in the implementation and in the details and in our follow through. Will we actually be able to do that? And will we be able to do that in a way that is predictable and reliable for American companies and for other companies that we work with? Because regardless of whether or not you're an American firm, you very likely have partners and allies that might be in other countries, and they need that certainty just as much as we do. The other two items on that list are an increase in natural gas purchases from American producers and lower taxes on Silicon Valley tech companies. So those may be more controversial for some countries. We'll see what happens there. All of this raises huge questions, at least in my mind, and likely in yours if you've been following this. I'm still really curious to see how these exemptions, whether they are narrow or broad, how they actually affect our high value manufacturing. Because obviously, if the exemptions are really broad, it's going to be difficult to see how tax revenue is actually garnered. That might be a good thing for US consumers. But remember that the whole reason that we're doing tariffs is ostensibly to fund tax cuts that the president has been advocating for. So the degree and complexity of those exemptions has a huge effect on the rest of us here in terms of the US debt and deficit, and also other things that we might have in terms of spending priorities. There's also the challenge of having these policies change minute by minute, day by day. It's exhausting just to read about, and it's even harder to actually have to run a company and try to respond to this in any sort of coherent fashion. The other thing to keep in mind is the president has now set this up such that he and his administration have to negotiate with at least 70 countries over the span of 90 days, which is just insane. It's a huge amount of work to do that. And on the back end of this, US Customs has to find a way to actually implement any decisions that are made. And again, assuming that those don't change in the future. We also touched on this in last week's episode if you want a better understanding of how that process may or may not work according to the expert that we brought in. If the goal of all of this was to command attention for the United States, certainly that has been achieved. But if the goal was to actually improve the US economy, it doesn't seem like that's going to be the immediate outcome, and possibly not even the outcome in the longer term, as economists and financial experts are almost universally predicting that we will enter a recession very shortly. Our next segment, all of this trade and economic policy is generating nothing but uncertainty for business, as we've already alluded to. Here are a few data points that I think really paint a picture of how severe the reactions are. First of all, even conservatives in oil and gas companies are reporting their level of concern. The Dallas Fed recently released some data from one of its surveys, and here are a couple quotes that I think are worth hearing. One executive said, "I have never felt more uncertainty about our business in my entire 40-plus year career." Another noted, "The administration's chaos is a disaster for the commodity markets. Drill, baby, drill is nothing short of a myth and a populist rallying cry." These statements are from traditional conservatives deep in the heart of Texas, and I think they speak volumes about the anxiety and the breadth of the worry that all of this is causing. Second, a key factor in the uncertainty involves our traditional economic advantages. Since World War II, the United States has really been at the center of global economics and the economic prosperity that has delivered to billions of people around the world. Brookings research recently revealed that the foundation of that economic influence, the dollar, is likely to be under threat. And some of the data that they cite, which I think is worth scanning, includes 60% of global foreign currency reserves are in dollars today, 64% of world debt is in dollars, and 54% of foreign trade invoices use dollars. All of these statistics mean that as Americans, it's easier for us to get lower debt financing, lower borrowing costs, and stable import prices. And those are advantages that we are very likely risking depending on how all of this goes. Third, post-COVID economic perceptions continue to really weigh on everyone, in spite of the fact that objectively the markets and the economy did improve after COVID. This research also comes from Brookings, and it shows that even though America implemented the highest fiscal stimulus as a percentage of GDP, which reduced poverty by 67% in 2021, Americans still look at the economy negatively. And it may not be a surprise to you, but the key factors include political polarization, housing costs rising faster in America versus other countries, and pre-existing economic dissatisfaction, which means that there's a persistent pessimism that is really affecting how Americans look at the economy and on our own lives. Fourth, American households are already exhibiting signs of distress. According to the CEO of Empower, which is a 401k provider, hardship withdrawals from 401ks exceed historical norms by 15 to 20%. These are the kinds of emergency withdrawals that incur income tax penalties and a 10% penalty. And they're typically used for things like medical issues or tuition or to prevent something like eviction. So these are pretty dire needs for someone to actually feel like they have to raid their retirement. Switching gears, let's talk about AI. We have been covering that quite a bit in our episodes this year, as you may have noticed if you've been here before. And there are two studies that I wanted to highlight that I think, again, speak to some of the confidence gaps that we see in AI. First, let's talk about a study from Pew. They canvassed more than 5,000 members of the public, as well as 1,000 AI experts. And the findings were stark. 56% of AI experts believe that AI will positively affect America, while just 17% of the public agrees. 51% of regular people feel concerned about AI's expanding role. Women are consistently more skeptical about AI than men, particularly among experts. One area of agreement is that 66% of experts and 70% of the public worry about misinformation and inaccurate information due to AI. Finally, 57% of the public fears a loss of human connection, which is significantly more than the 37% of experts who said the same. The other AI study is about The other study is about AI in the enterprise. So while experts remain optimistic, implementation reality seems to be telling a different story. The S&P Global Market Intelligence surveyed more than 1,000 businesses in Europe and North America. They found that 60% of organizations have implemented AI, and 46% have abandoned AI proof of concepts. 42% of AI initiatives failed in 2025, compared to just 17% in 2024. This dramatic increase in failure rates seems to stem from the gap between the impressive demos that a lot of tech products can offer to executives versus the operational reality once those tools have been implemented. So this may be a harbinger of additional challenges for SaaS business models, as we've talked about before, because the economics of a lot of companies depend on their ability to sell into the enterprise successfully and over a long period of time. As always, thanks so much for listening. We hope you enjoyed this episode. We'll see you here soon. Thanks for listening. If you liked what you heard, leave us a review, subscribe to the show, or check out another episode. We appreciate your support.